Welcome to CoinGecko's 5th meetup. Thank you very much for taking the time to come join us here today. So yeah, as you can see, we have two really distinguished guests. Michael from Boxmining, say hi.
Hey, hi guys. I'm Michael.
And we also have Kerman Kohli. He runs DeFi Weekly. He's founder of ARC. A lot of interesting things. You'll hear more about him in the next 1 or 2 weeks. He just told us off record early just now.
You guys are getting some exclusive alpha leaks in this interview, so this is well time spent.
Let's jump right straight in. Like, this is the DeFi Yield Farming liquidity mining meetup that we are doing here at CoinGecko. Obviously, we are big fans of DeFi yield farming, liquidity mining. Personally, I'm doing a lot. I trade tips with Michael a lot. Like, we kind of see who is more YOLO into the contracts that the latest farms that launch. I guess after this, I talk more to Kerman and see which ones that we should go more in. But I guess for a start, like Kerman and Michael, like let's jump straight. Like, maybe let's start with the definitions, right? Maybe you can explain what is DeFi yield farming and liquidity mining.
You want me to start, or do you want to do this, Kerman?
You go for it. It's cool. I'll take the next one.
All right. So I think this is one of the most bizarre and amazing experiences I've had, because yield farming is a very simple act of just depositing some form of cryptocurrencies and you get another cryptocurrency out. And typically what people are looking for is that cryptocurrency that you get for free. That one could be worth quite a lot of money. So typically speaking, I mean, you walk in the bank these days, you know, you put a deposit down, you know, I've done that with HSBC. You go there, walk the counter, you're like, boom, here's a stack of cash. How much yield can you get me? How much can I get on my deposit? And then the guy would look at the counter, you'd be like, I'll give you 0.6%. You know, that's a bank rate. But in yield farming days, that's like nothing, right? Like, you suddenly go into this DeFi space and you start talking about, you know, let me put some cryptocurrencies down to this whole DeFi contract, and how much do we get there? And those numbers are astronomical. You know, I started off thinking, oh, 30%, this is a lot. Then it went up to 300%. And now sometimes we're getting like 3,000% back APY. And I'm like, my mind is blown, right? There's got to be a scam. This cannot be real, right? There's no way this can be real. There's just so much going on. What is really happening in the back end? What is happening with yield farming? And I think this is something that really popped up around 3 months ago, where all of a sudden there's a lot of kind of the reason why all this is going on is because there's a lot of new coins being created. So all of a sudden, instead of people running off and doing an initial coin offering, a lot of people are issuing coins on a yield farming platform, which is why we get so much APY, because these new coins all of a sudden generate a lot of hype and a lot of people buy into it. So I think this is all of a sudden the reason behind why these yields are so high. And I think it just baffles a lot of people. Even when I was talking to CZ, so CZ from Binance, CEO of Binance, you guys probably all know him. He was like, oh, yield farming, we're looking into that too. You know, sometimes these yields are insane. They got 10%, 100%. I'm like, CZ, are you kidding me? That's 2,000% right now on base or something, right? Like, keep up with the news, guys. Come on. You know, like, why so out of date? So that's kind of the situation right now, where there's a lot of new coins, a lot of new projects. They're very early stages. So the supply is super low, obviously. So there is definitely a lot of risk associated to it. And we saw that there were multiple attempts to scam people. Obviously, this is not pure alpha leak. I think Kerman said, you know, this is an alpha leak. It's not pure alpha leak. There's also always a lot of risks associated to that. But of course, it's also very interesting to follow. I think I started yield farming when I kind of started using Y curve around, I think 1.5 months ago. All of a sudden they start issuing this token on Y curve on this Y project thing, and then all of a sudden it's called Wi-Fi or Wi-Fi, depending on how we want to pronounce it. But if you're a total weeb like everyone else, it's Wi-Fi or Waifu. But all of a sudden, you know, all of a sudden they distributed this new coin. It was like 1,000% APY. I was like, oh my God, this is crazy. All of a sudden I'm jumping from 10% APY to 1,000, and then this new coin was being distributed. So I went in, I told all my friends, and the degenerate ones, the guys who were all, a little bit crazy, they went in big as well. And it's been a crazy ride ever since. I think that's a huge wealth generator for a lot of people. So there's a huge pull. I guess that's why we have 900 people watching here. But obviously throughout this journey as well, I started learning about, stuff like impermanent loss, etc. But we kind of decided before coming here, we definitely need to warn people of the risks associated with this. But I think I'm pretty much done explaining what yield farming is.
Yeah, and just like adding to that, I think just in case like someone's a bit confused about where these really high numbers come from, the best way to think about it is like, imagine you went back 5 years and your friend told you about this app called Uber where you could like press a button and get a ride on your phone. And you weren't too sure what it was, but it seemed to provide value, so you used it. And instead of just paying Uber, Uber actually in real time grants you Uber stock for using the Uber service. And because you've done a ride on Uber, Uber is now maybe 1% more valuable. And therefore the Uber shares that you just earned are now 1% more valuable. And what eventually happens is you have this virtuous cycle where a user comes in, they use the product's now 1% more better. Therefore the valuation is maybe 1% higher. And this loop just goes on like really, really, really fast to the point where you end up with like 1,000%. So a lot of these yields are, I would say, subsidized by future growth, where you're betting that the value of this coin will keep going up based on the fundamentals of the product. So it's different to the ICO nature where you're waiting on the next buyer to buy at a higher price, but rather you're all collectively playing this game where you think that this token will have sustained future value based on the metrics for usage of the underlying protocol.
Yeah, I think you explained it really well, Kerman. Like next time someone asks me why is there such high yield, this is probably the reason why. Like I think crypto allows allows protocol developers to share the upside with the users of the protocol itself. And you brought up a good example for Uber. We are all we use Uber, we use Facebook, we use Airbnb, but we create value to these corporations, but we don't get any value shared back with us, except that we just one user and they're milking us. Whereas in crypto, we actually get rewarded for using this product. That's kind of the thing for all of us. So yeah, that makes a lot of sense. Having this yield being shared to users like us. But I guess my question that a lot of people ask next is, first is where are the yields coming from? The second question is, are these high yields sustainable? So want to hear your thoughts about that.
Sure. So I think the answer is no. I think right now we're like crypto's got like this new toy and everyone's like going really crazy. It's like, whoa, crazy high APYs. But I think what eventually kind of will happen is, right, I know roughly in the next 3 months, there are going to be more projects than most of you can like even comprehend. And there'll be so many yield farming opportunities. Most yield farmers will probably like lose their brain trying to figure out where to actually deploy capital. And because there's this increased competition for yield, you'll also see yields kind of go down. But that's a really good thing, because once we have sustainable yields, whichever product or service you use or wherever you deposit your US dollars, you'll actually have sustainable yield farming, which will accumulate a lot more than the current yield farming hype. Because if you were to kind of plot the yield farming yields, it kind of looks like that, 1,000%, and then maybe down to like 30%. So instead, like if in a future where we have like a sustained kind of increased yield over a longer time period, that's where I think the gold and stuff happens, and you have true long-term alignment between users of the protocol and token holders.
Man, I love how Kerman is so eloquent with his words. It's really great. And I think I kind of expressed it better, but I think I'm going to offer a slightly more kind of cynical viewpoint as well on this. I definitely think it's unsustainable. I mean, anything with 1,000% APY, I don't think really can sustain itself. I think there's a lot of recursion going on in this field. So one of the issues here is like, so let's talk about the first kind of crazy one, which is YFI, right? So eventually you deposit your funds, you get some YFI back, and YFI is really, for now, right, currently is a yield aggregator. So they have something called Y Vaults, where you can also deposit funds there, and this will be used to farm other projects. And they have various things called strategies, which can be deployed to farm other yield farming projects. So we almost have this recursive loop going on. So, okay, after YFE was issued, there was YFE2, now there's YFV, shout outs to that community. We have like spaghetti.money, we have shrimps, we have zombies, but these are all the kind of the same idea. Like they're all going to be yield aggregators. And then you have yield aggregators farming yield aggregators, and then yield aggregators farming yield aggregators, farming yield aggregators, farming yield aggregators. It's a recursive loop. You know, at what point do we say stop? We have enough yield aggregators in this space. And the moment that stop happens, obviously, when new aggregators aren't getting as much attention as they are, as the tokens don't get as much value, it's going to cause a chain effect. So there's these new aggregators coming in, not getting as much attention, not generating so much value, their coin's not worth as much, so the yield is lower for them. And then the yield farm aggregators farming that will also get lower yield. And then the yield aggregators farming that will get even lower yield. So I think this is going to be, you know, it's going to have to just enter a more stable cycle right now, because we're still in the honeymoon phase where everyone's like, okay, this is interesting. We're going to add yield aggregators and rebasing, or we're going to add yield aggregators, rebasing coins, and we're going to get some mining things out of it. You know, we're adding, like, we're still in a honeymoon exploratory phase, which is what makes it interesting. But I definitely don't think it's going to go out for a super long amount of time, at least with the 1000% APY stuff. Probably maybe like, you know, a normal, more reasonable amount makes sense.
So I guess you guys both brought up, I mean, Kerman said something more sustainable in the future. Like high use, I don't think it's sustainable. You can't stay 1,000, 2,000% for long. And something that makes more sense, which is what Micah said. So like, what is a more sustainable yield, right? I mean, if you think about stablecoin, I mean, US dollars, like you put in your bank account, you get 0% interest or sometimes negative interest depending on where you are. Or if you're in Asia, maybe you get like very minimum 1-2% in your bank. But so what is a sustainable yield then if this goes on for a long time, like that things don't go up and down? Like would it be like around 30%? I just want to hear your thoughts here.
Yeah, so I think I'm working on something new, which is being announced, saying I've spent a lot of time thinking about what does sustainable yield farming look like. And I don't think I have the answer yet, but I think the way like yield farming will look in the future is more so a coordination mechanism. So if you think about Wi-Fi, base, all these things, they seem like protocols, but they're actually games. And they're games where they force everyone to work together. Like if you think about your everyday life, which game do you earn money if you work together with everyone else? The answer is probably zero. Like if in your job, you're trying to like take out the guy above you. If you're like dating, you're trying to compete against all these people. But in yield farming, it's actually a way to get all these people over the internet who probably like will take each other out if they could, but forcing them to work together, kind of like the original ethos of Bitcoin. And what projects will then do is kind of use yield farming incentives to force people to play together in this really nice way. And because they play well together, they then create wealth together for everyone. And these yield farming opportunities won't be like these continuous things where you throw your money and you forget. You'll actually be engaged in whatever the project or team is going to be doing, and you'll be kind of part of whatever they're doing on a more deeper level rather than just using the product and service and going somewhere else.
I think, so talking about numbers, I always hate giving out numbers, right? Because everyone's going to go crazy. But I feel like it's probably going to be a little bit higher than 30%. And I think we should definitely break it down to what are the risks associated as well. Because right now I can feel like there's two distinct types of yield farming. So one is just one where you just purely deposit USDT or some form of very, very stable currency into a particular contract, and you don't suffer any impermanent loss. This is quite important. So this is less risky. The real only losses you suffer are either the smart contract breaking and someone just completely locking up your funds or siphoning off the entire contract. So you have to be very good at reading contracts, and that's where, you know, some developer skills come in. And then the second type, which is where you put your funds into a liquidity pool. One of the popular ways of doing it is do a 90% stable coin and a 20% kind of the shit coin. I'll be affectionate about it. 20%, you know, whatever coin it is, right? So affectionately saying shit coin. So with these liquidity pools, the problem is if the coin drops drastically in value, then you're going to suffer something called a permanent loss. And this becomes very permanent if you ever want to withdraw. So take for the example, when YFI first started, for some reason, the coin was around $800. So, okay, sure, $800. Put that inside. And then also this is my experience. I got a little bit burnt from that. So I bought some YFI2, YFFI, not YFI2, YFFI, paired it up with DAI, put it in the pool, started mining or liquidity farming. But as that coin dropped in value, it just plummeted from 800 to 90, and then from 90 to like $1. These losses are huge because not only did you buy this coin, but also because you're in the liquidity pool, you're effectively buying the dip. Every time someone wants to sell it, you are on the other side buying that dip. So that means you're accumulating more and more YFFI, and then that leads to this situation where you could suffer impermanent loss. So with this type of kind of farming, so anything that's in a liquidity pool, we see much higher APY. So we see much higher returns because the risks are much higher. So I want to break that apart, because with this type 2 pool, like the rewards right now, I mean, if you see it in YFV, you're getting around 800% APY. So I feel like with this type of pool, you can definitely still, I would say maybe sustainable would be like 300% or 400% if it's a new coin, if it's trying to establish a price. You're effectively here, what you're doing is you're actually doing something. You're providing liquidity for swaps, right? So the effectiveness of this is that developers want you to do this. They want to incentivize you to do this because you're effectively crowdsourcing a liquidity provision to that trading pair. I know that there are market makers and they charge a lot of money for projects. This can range up to 6-7 figures sometimes, especially if it's a big project. It could be quite a lot. And what they're doing here is projects are saying, look, I'm going to give you a bit of my coin so long as you come and crowdsource and provide some liquidity for me. So I feel like that side, I think maybe we can get 300, 400, maybe sustainable. We'll see. Don't quote me on that. And then for the other side, where there's like the type 1 pool where there's not too many, risks of impermanent loss, I think that could go down to like 60, 70%. Maybe that could be, and that's the way we're going right now with a lot of these projects, even Curve and with YFE, which is down in normal pools, you get around 90% right now, and I expect that to go down a little bit over time.
Sure. Oh, sorry, carry on, Bobby.
Yeah, I was gonna say, like, one of the hardest thing for me is, and that's something that I don't really dare to do, is like to participate into this like part 2 kind of yield farming, where like putting liquidity on Uniswap. Like I would put in like liquidity on Curve and Uniswap if it's a stable coin pool like USDC, DAI, USDC, USDT, or a bunch of stable coins, like, because there's quite low risk of impermanent loss, unless of course if DAI breaks the peg, then yeah, I get wrecked. But like, for example, like Michael, you are quite daring in putting into all these like YFII, YFFI, and against ETH, against DAI pool. Like you get hit with all this impermanent loss. How do you go about thinking with the risk and the potential loss that you can make from the and balance it against the potential gains that you can get from it?
I have to say I'm a full-on degenerate. Just gonna put this out there. Like, I'm not gonna pretend that this is something that everyone can have access to. A few things. I think there's definitely a lot of value in projects. That's the first thing that YFI, so the first YFI, taught me, which is that there is actually quite a lot. I mean, Andre is developing a lot of tools. He has a whole suite of everything, and it's one of the coins that, whilst I initially farmed it, I sold a little bit too early. I mean, I can look back at it now. I was farming like 5 YFI per like 6-hour period, and I was like, oh, I'm just gonna dump it. So I feel like there was a little bit of regret. I think it's starting to game on me now that YFI is above $10,000. It's starting to be like, oh, maybe you should have paid a little bit more attention and see how things go. So that's why also I'm okay with a little bit of taking a permanent loss if I don't mind holding that coin for a longer period of time. So if I'm holding this coin anyways, and I say, look, okay, I think this is where you still have to have a little bit of trading chops drops and think like, okay, look, it's like right now it seems like the FUD is gaining. Maybe this is a good time to farm. The worst time to farm is when everything is hyped and the coin goes really a lot high in value. That's like the worst, because you're gonna buy the top, right? And then you're gonna ride it all the way down. So here you're trying to look for a strategic timing. This is where you have trading chops coming in. But I do have to say that I think only roughly 1/5, probably a little bit less than 1/5 of my funds are in any pools that can take impermanent loss. So I'm not that degenerate. Like the fact that I'm touching it, I say I'm degenerate, but I'm not like full on 100% of my funds all in, into some sort of degenerate pool. Definitely not. But I'm definitely want to have a little bit more exposure. I think some of the pools work very well. And yeah, that's pretty much the case right now.
Yeah, Kerman, how do you think about impermanent loss? I'd like to hear from you.
Yeah, so permanent loss, I actually have a video on this on my YouTube channel, but let me try to re-explain it really quickly. The idea is that whenever you go to Uniswap, you have two tokens, and the ratio of these two tokens determines the price. And if you provide both of these tokens and someone buys a token off your contribution, you now get more of the other token. And the simple equation, which you have to figure out, is if you let other people take any one of your tokens, would you have more money compared to if you just held those tokens by yourself without Uniswap? And the difference between those two is what we kind of classify as impermanent loss, in a nutshell. And I guess like just reading through some of the comments, people like, how do you evaluate a yield farming opportunity? Or like, what do you know what's good? Should I take this or not? And I think like it really comes down to like, where is the value being created over here? Like if you strip away all the hype, strip away everything, you say like, how is this actually improving or creating value? Is it generating cash flow for someone? Is there an experienced developer team about this? Just like if you evaluate this as an investment and see like, how is this going to do something good for the ecosystem? You can make a lot better informed decisions about like whether you should take on an impermanent loss, as kind of Michael said, and holding on those coins over a long period versus whether you should sell it straight away.
Yeah. So I'm just going to pick a couple of questions that I've been seeing in the comments as well. So there's two, which is kind of related. Like question from Ben, like how much do you need to stake or to farm to really make money, considering that gas fees are pretty high? And then the other question, the same one, Jatan as well asked, is it Jatan? Like no, Digital Box asked, what is the minimum amount to start yield farming? So it's related to gas fees. I've paid crap load of gas in the past couple of months yield farming. I mean, for me, I always tell people that you sort of need like at least $10,000 to farm in any one pool to sort of make sense. If not, then it's just really hard to pay for the gas. But like, just want to hear your thoughts. Like, what do you think? How much do you need on a minimum? And then maybe from your experience, when is the best time to participate in yield farming? There is the best time where the gas fees are typically low. I think typically 7 a.m. Malaysian Singapore time. But yeah, I'll hear your thoughts in it.
I'll go very quickly on this one first. First of all, yeah, morning Asian time is great. I think all the Asians are degenerates, and then during the day in Asia, gas fees get really high. So yeah, just avoid the degenerate Asians first of all. Second thing is the minimum amount. I think this is something that like it's a high risk. Obviously, I'm not trying to promote it, but something that I did when I first started yield farming is I only use like $100. All right, it sounds stupid. I'm paying like what, $20 fees on $100. Why? Well, because I'm testing this out, right? If it's a first ever time putting money in a staking contract, you want to test it out. You want to make sure that it's safe. It's like doing a test send, right? So I feel like that's possible. Like you're definitely gonna spend maybe even waste money. I always test like stake it and then unstake it. What happens? Do I get my money back? Or like what's the contract I'm interacting with? I stand on MetaMask. I look at the code. I look at everything. So yeah, just like sometimes starting off with a small amount, rather than 10,000 in one go. I think 10,000 in one go obviously blow my minds out if I'm just starting yield farming. But yeah, that's my 2 cents.
For sure. Yeah, I have this slightly contrarian opinion, and that's actually just buy the tokens if I think they're good. So if the price is less, if you have less than $10,000 you're playing with, seriously, just find something that you think is special and like throw money at it. Because since these opportunities are so high risk, the probability that you lose your money is basically the same. So if your downside is the same, you might as well just buy the thing and hold on to it and hope it goes up. And that's kind of what I did with Wi-Fi. I was like, I don't think I'd be prepared to go in super large. Let me just buy a bunch of Wi-Fi. And in retrospect, that decision turned out really good. And what that allows you to do is A, save a lot on gas fees because you're just buying from Uniswap. But B, it just saves you time and mental space. You're not like on edge, sleeping like, shit, is this pool still up? What's the return like? Are people dumping? And it just lets you sleep better at night. So like if you're yield farming, I'd almost think it's like two categories, right? The one category is the above $10,000, is technical, knows what they're doing, has like the right friends to do due diligence with. And then everyone else, you should probably just buy the coin. And the challenge is, can you make enough money from buying these coins that you make 10 grand and then become a proper yield farmer? So like yield farming is a title you earn, not something you can do straight away.
I actually want to disagree with that. Actually, I view all of these assets being created as very high risk because when yield farming first starts, like say when a coin first launches, the supply of that coin is extremely low. Think about it. If it's only been mined for an hour, then there's only 1 hour of yield to buy, right? And then in another hour, that amount would double. Right. And then in another, like a day, that's like what, 24 hours, that's another 24x, right? So you have to be extremely careful here. And I've seen this being a miner, right? So I've mined for a long time and we've seen this a lot with the new speculative mining coins that in the initial section, there's a lot of hype because this coin just launched. Everyone's like, oh my God, I'm mining it. And you go and buy it, you're going to run yourself into some sort of crazy chaos. You're going to screw yourself over. So not financial advice, of course, not a financial advisor, etc., etc. But like this has been seen again and again when coins first launch, very, very high value. And then as the supply slowly, gradually goes up, it goes down. The only exception to this was Wi-Fi. So when Wi-Fi first came, it had a 1 week distribution and said, okay, we're going to stop after a week and then we're going to figure out what to do. Now, the interesting thing is a few of my friends understood the gameplay here. So they didn't just buy to speculate. They bought it to screw with everyone else. Because initially all the farmers were thinking, there's going to be more. You know what? This is the first week of distribution. There's going to be another week. There's going to be another week. The supply is going to grow. There's going to be more weeks. But some people just bought this up, went to the governance and said, we're going to block every attempt to issue out new coins. This is it. This is done, over, game over for more Wi-Fi, right? So at that point, I was like, screw you guys, like screw all you asshats. We agreed on creating more. We're gonna make this thing, farming. It's gonna be great, and you guys bought it up and screwed with the governance. So I think that happened with a few of these DAOs where they bought the coins. This is really big whales. They bought the coins. They created something that reduced its supply, so it made it more valuable and made a few plays off that. So I feel like if you can make those plays, sure, but if you're not, then I think these coins, if they can keep going, the issuance keeps on going, then just be extremely careful because we're still at the very early stages. This is barely like 3 weeks since anything started. So, what happens in 3 months, right? So there we go.
Yeah. And like completely agree with Michael. You have to be really careful about what the supply is like. Like I think there's the comp and the curves of the world where like they start off really, really hot and then they just keep sliding to oblivion. And I think a good rule of thumb is like wait a month. And like you'll get a good sense of where things are at. The more hype it has, the more you should probably just stay away. You're not going to get in first. Like there are people with like ridiculously good engineering skills who know blockchains in and out, and you're basically sheep that will get slaughtered chasing after these returns or even these coins. So like really just like wait a week or two, let the hype die down, and you'll be able to make a much more informed decision. But I guess it's not as fun compared to getting in and out. But if you're getting in and out, realize you're probably going to lose everything. In gas fees, price action, or impermanent loss. Choose one of your three choices.
Yeah, I just want to say, like, I mean, this scenario with yield farming and chasing the newest coin to farm, like, it actually reminds me a lot of the time in 2014, 2015. I think Mike has been around mining all those shit coins back then. New coins are being launched, and then you have people like Insta mining those coins and then dumping them on exchanges. I think the current scenario is fairer in the sense that you can participate without the need for mining rigs. I didn't really have mining rigs at home to kind of participate. Now I don't need to do that. I just have to have capital to kind of farm these coins.
It's like, yeah, we don't need GPUs anymore. We just have a ton of cash. This caters to us. This is great.
but it's the same, right? I mean, to have GPU, you need to have the cash to buy the GPU and to manage the farms and all. Like, it is still capital. It's just like, let's cut short that farm, that mining part, remove all the capex and opex, and just just put capital and deploy them. So that, to me, we are replaying a lot of things and scenarios from 2014, 2015, 2013, and sort of like be careful, because a lot of these coins, their supply increase exponentially, and then you get dumped on. I think, as you said, like the only exception was Wi-Fi. So I farm as well, and then I thought like you were dumb, but like there was a wrong decision to sell my Wi-Fi, those valuable coins, when I was farming them. Didn't realize the mechanics of it. But
that's because we didn't know. We didn't know the DAO.
Exactly.
People were really smart. They made this 200 IQ decision to just take over the DAO and just block any attempt to issue more. So I think it's not a wrong decision. I don't have any regrets, but I'm learning to have 200 IQ plays now.
It's either your low IQ or your high IQ. Everyone in the middle who's sensible gets correct.
We all saw that meme, man.
Yeah, we gotta be the degenerate and just like buy. Like, that's one of the things that I don't want to repeat myself again. Like, just like miss out on all the hot coins because I overanalyze and overthink them. Sometimes just like don't think too much and just, because I mean, I can of course absorb the risk. If you can't absorb the risk, please don't do any of these things. Because like let's jump into one of the risks. Like Wi-Fi was the exception, but let's go to the other extreme where let's talk about Yam. Yam was launched, and then there was this rebasing function where the rebase target was $1. I think at the start it was trading at $400 or so, and then after like 24 hours, it just went to like complete nuts. Like, it just went like valueless. So like maybe Kerman, like just explain to us briefly, like what is a rebase function in like some of these coins, like maybe Amperforth was the first to put in, and then we saw that in Yam, and then like Yam completely exploded. Didn't go the path of Wi-Fi, but like, let's kind of listen a little bit about that.
Yeah, so a rebase. Let's put it this way. You have 100 credits of something, and we say one credit is meant to be $1. Now, people say, you know what, why don't I hoard a bit more credits and try and get more so I can hope that maybe if it does go up in price, I can make a profit. Now, the creators of these credits, they want this to be $1. Like, that is meant to be the ultimate goal. And what the creators say, that if the price is over $1 every 8 hours, we'll keep checking, we will actually mint more of your credits so that each credit is worth less. So one credit is, say it just hits $1, but then people get excited and a credit becomes $2. Now everyone who had 100 credits will now suddenly get 50 credits worth $2 each. And suddenly that means that you've got all of this, sorry, I'm getting mixed up myself, but you've got one credit worth $2 and 50 in total. And basically the protocol itself will actually take credits away from you. And because there's less supply, wait, shit. Sorry, I think I'm getting messed up myself. Michael, do you want to take over this one? My brain's
I'll take it over. I'll explain it in the dumbest way possible. The way these things work is it's almost like a game. Basically, the smart contract, the coin is self-aware of its price. Right. This is the way it's almost like a Terminator. This coin is like, oh, I know what my price is. All right. And then I can do something called a rebase, and I can try to change my price. But this rebase function affects everyone holding the coin. So let's say I have, and if you think about the best way to just describe it is it started with Amperforth. So let's say I have 1,000 Amperforth. It's worth $3 right now. And Amperforth's AI is like, yo, I don't want to be $3. I want to be $1. Right. So when it sees itself, it says, okay, look, it's my rebase time. I look at my price, $3, too high. Not good, not good, not good. So then it says, boom, I'm gonna multiply myself by 1.1. Why not? I'm gonna increase my supply. Right. So everyone who's holding Amperforth, they have $1,000 of it. Suddenly they have 1,100 Amperforth. Right. So all of a sudden, that supply increases, and now people can dump, right? People can be like, oh, okay, let's just dump a little bit of this extra, let's lower the price. And then eventually, gradually, ideally, it should gradually tend towards one because the contract is self-aware. It's constantly doing this rebase, constantly doing a multiplier every set amount of time. And this is different for every coin. Like they all have different strategies. Some coins target $1 and they'll do the functionality to target $1. Oh, I forgot to describe as well. If it's less than $1, it'll shrink the supply too. So it's a debase, if you want to call it. So it's just self-aware. It does something to correct its price. Overall, like some people feel like this is very valuable. I actually think it's not very valuable at all. But anyways, I feel like this is pushing price volatility to supply volatility. So all of a sudden you have a dynamic, flexible supply rather than a dynamic price. So it's just like pushing the volatility elsewhere. So that's the way I view it. And yeah, so just quick to roll back that down to YAM again. So YAM prices went up. So YAM being self-aware, it's like, okay, look, let me multiply myself multiple times. And YAM was ultra aggressive. It had like, I think it was a 12-hour rebase, and the rebases were extremely aggressive too. So all of a sudden we saw there was one instance where YAM was $100, boom, 10x its supply. So boom, it drops to $10, right? And then people were like, oh, buy the dip. So it went slightly up. So technically YAM pumped even more. But anyway, so that's kind of the issue with rebases and why it confuses people. But I hope you guys understand a bit about these rebases. But to explain what happened with YAM as well, was that their rebase functionality really screwed with everything else. It created a situation where the contracts themselves just kind of blew up, and the governance itself was unable to, YAM was unable to be governed anymore. Okay, that's a quick summary. Like because of this rebasing function, because of this fancy, crazy, this crazy AI that's aware of its own price, it got to a point where YAM could no longer be governed. It became a self-aware terminator, and then it blew up and people were like, okay, that sucks, and QQ were out. So I guess that's a quick summary of what happened.
Yeah, I think YAM was extremely dangerous. A lot of people who participated in YAM were not aware that there was a rebase function. I took part in it. I bought some YAM without realizing there was a rebase. Only after a while that I realized, shucks, shit, there was a $1 rebase target. Why the hell did I buy it at like, I don't know, $100 or so? And then
but the rebase, it doesn't matter, right? If it rebases, you're still gonna get like 100 times more. The rebase function was not the problem. It was the developers that screwed it up. The contract was not audited. That was the problem.
And I remember correctly, like the rebase tokens, like in Amperform, you get all those tokens. I think for YAM, like the tokens goes to this governance contract.
No, you still get it too. You still get it too. You get like 98% of the tokens. You're great. So I held YAM during the first rebase, and I was like, whoa, nice. I I'll have like maybe 600, and I had 6,000 afterwards, or like 9,900, like 9,000, like whatever. It's like 5,980 or something like that. So it was fine.
Yeah, and like the really crazy thing about the YAM rebase, the way it broke was like the difference of like 6 characters. Like if those 6 characters were in the code, we'd still have YAMs, but 6 characters makes all the difference in smart contract development. These things are extremely fragile machines, and we're playing around with them like they're Web2 social media apps.
but that is, I really think that this rebase function, although very dangerous and very risky, creates this entirely new game in crypto where like what happens in one coin is not correlated at all with the other coins. So before this, like every single coin is sort of correlated with Bitcoin. When Bitcoin goes up, everything else goes up at a higher volatility and vice versa. But like Amperform sort of broke the trend, and like now Amperform is kind of like its own, like Michael says, his own AI. He has his own mind. It does what it does, regardless of what Bitcoin or Ethereum or anyone else does. And like, I guess we saw the same for YAM. And I guess we are going to see more and more of these things, and one of our guys actually, Johnson, did an article on CoinGecko. But if you look into this rebase function, and all these things have different variation of rebase functions coming out, which is actually more complex and interesting things, but very risky as well if you don't know what you're doing, of course.
Absolutely. And one big tip, just a big show for our CoinGecko here. If you go to CoinGecko and instead of looking at the price, look at the total market cap of any of these rebase coins. That's the best way to figure out what's going on, because the price is what's going to fool you. Everyone is like looking at the price. They think that we're pre-programmed to think about the price. But if there's anything with a rebase function, efficient because the supply is elastic. And I think humans, we don't understand elastic supply naturally, right? So the best way, go to CoinGecko, love your feature here. Click on, the market cap of this coin. So the total market cap of this coin, you'll generate a graph, and that's the best way to look at the value of these coins. So look at market cap rather than price.
Yeah. For all these coins with rebase function, look at the market cap and not the price chart. Like that would be the key for doing technicals and all if you want to look at it. And also like look at the fully diluted valuation, which we just roll out for any of these coins. Like that's something to compare for any of these DeFi yield farming coins as well, to look at the things. Guys, before we finish up, we must talk about risk. We cannot end this. Like we mentioned risk many times, but like let's jump into like risk and like maybe Kerman, like let's start. Like I've watched your videos. You have described some of the risks involved. Like there are multiple different risks. Maybe you can kind of like talk about some of the risks inherent and why this is very profitable and interesting, but also very, very risky.
For sure. So I'll start off with like the easiest risk to spot and then work down the line. So the biggest risk is like the integrity or the people behind like whatever yield farming scheme is coming out. If you don't know them, they're anonymous, you're probably going to get exit scam. Like you don't have to look too deep beyond that. But sometimes they might be good, but that's, I think, like one red flag where you're like, I don't know this team. If something goes south, like there's no reputation lost and like someone just made off with $100 million. And then your next risk, which ties into the kind of ethicalness of the team, is have they implemented any backdoors? And some of these backdoors are getting increasingly complex and really tricky as well. So have they added a backdoor which allows them to mint 1 million of this coin, sell it on the market, and then cash out? Have they implemented a backdoor which maybe purposely breaks things? Have they implemented a backdoor which actually just lets you destroy everything forever? There's like, the code could have something really glaringly obvious which allows the attackers to take control. And I think with YFV, if I'm not mistaken, they had this thing where the owner got destroyed, but the smart contract had multiple minters and the minters were still active. So you could be like, oh, we destroyed the admin key, but who cares if you destroy the admin key if you can still mint 1 million tokens? So that's like one level, that's like another level deeper. And then like the deepest level is kind of like the code actually just doesn't work for whatever reason. And eventually some point in time, somebody's going to hit the right function at the right time and destroy everything. And that's basically what happened with YAM. So like the people were ethical. They didn't have any backdoors, but then the code was broken. So that kind of caused everything to go belly up. So I think that's like on the technical side. And like that's trial one of like, you just need to make sure these things are in check. The second kind of set is like the economic risks, which I think Michael alluded to before, which is kind of like, okay, in the staking thing, when you play this game, even if the game works as expected, will you probably lose money because there's very little supply and the prices pump like crazy and then it's going to crash? Or are there going to be so many tokens minted that it's going to become valueless? Or is it just like staking by impermanent loss is going to make you a loss? Or will gas fees actually destroy you, as in like interacting with these contracts is very like intensive and you'll need a lot of ETH, that even any profit you make at the end of it will kind of render everything useless. So to kind of just re-summarize, you've got like, does this thing do what it was advertised to do? And then if I do the thing which was advertised to do, will I make money? And that's how I like classify risk when thinking about yield farming.
I think I just want to add very quickly to the risk of token minting. So I think that's probably the biggest risk and the biggest type of scams out there when it comes to yield farming. I think right now we're kind of all like I'm reading the chat and we're all kind of degenerate, and that's not good because we're all trying to rush into every new project because they have, what seems on paper very promising yields. But the problem I think is when it comes to token creation, if there's a way for the founders to create 1 trillion tokens just out of the blue like that, right? Because before, when these coins launch, they have a very finite supply. Let's say when it starts off, on the market, there's 1,000 coins. great, whoopee, right? Maybe every coin's worth $10, or maybe let's say $100. So $100,000 for the overall circulating supply market cap of this coin. So you feel safe. You're like, okay, it doesn't really matter that much. But if the founder can mint 1 trillion tokens and just dump it all at once at the market and just like completely drain everything, this is the biggest risk you can encounter. And if you're mining on anything with impermanent loss, you can lose your entire stack. And this has happened. So YYFI was one of the first examples of this. There were people who were mining in a pool that was in a liquidity pool providing for this. And then there was roughly at that time, I think there was $700,000 inside or whatnot. And then the founder of this, he built a backdoor himself. And it's not even built a backdoor. He just used the minting function. He just didn't destroy the keys to mint, right? So he said, okay, I'm going to just create a million coins out of nowhere, throw it on the market, IDOs, peace out, guys. I have $700,000 pretty much. The actual story is a little bit more complicated. There was actually a review of it somewhere, but like he actually also screwed up by not minting enough tokens and also not dealing with slippage very well. So a lot of smart farmers got out in time before he exit scammed. But that's one of the risks. You got to make sure that, a lot of these contracts, they're based on synthetics. And especially if you're using the YFII contract, a lot of people are just copy pasting using that. There's a governance address and a minter address, which can both allow the creation of infinite tokens. So you must make sure that both are burned. And you must also make sure that the governance did not issue out any other minting addresses. So it's like Lord of the Rings, right? There's 9 rings for men and 7 for dwarves. I forgot what it was, but there's 1 ring to rule them all, right? You must make sure that that 1 ring is also destroyed, and you must also make sure there's no other rings out there. Because if there are rings out there, then you can meet a situation where someone just can create a lot of tokens, dump it, and boom, adios. And I think the other risk, very quickly as well, recently, I think you guys talked to YFV and also YAMS. There's also just dumbass mistakes by developers. They're pushing out these code very, very quickly. It's probably even not dumbass mistakes. I'm such a cynical person. I guess I'm affectionately saying it's dumbass, right? But if they don't program these contracts properly, they don't behave how they're supposed to behave. For example, even in YFE, there was one pool where the unstake, some hackers can attack it in such a way that it prevents people from unstaking. So it was just like, okay, you have this small mistake. No one really lost money. It's just that they couldn't unstake. But anyways, that's some risk you have to take into account as well.
All right, so we are sort of running towards the last 12 minutes of this meetup, but let's talk alpha, guys. Let's talk alpha. Everyone's here. They want to hear some alpha, so let's kind of give them what they want to hear, right? So where do you guys find the best or the most profitable yield farming opportunities at this around, and how do you know which is safe, which is not safe? How do you choose? How do you go around your research?
Follow Daryl. So this is a joke. Daryl Lau is part of their team and the CoinGecko team, and Daryl always sniffs out the latest dig. So that's my contribution.
Yeah, in case everyone's looking for something a bit more concrete, the safe yield farmer in me says, find a coin which you already hold and find the most profitable, simplest opportunity with that. So one of my combos back in the day, which I shilled a bit, was if you have some US dollars, get USDT and USDC, put them in compound, you get C tokens, and get those C tokens, put them in balancer 4949 pool, and then you kind of earn comp and it gets sold automatically, and you're accumulating balancer tokens. So I guess another way to put it is given the assets you have, what are the most profitable strategies which might not change in the future? So if you're big on SNX, go on the SUSD pool. That is pretty lucrative. And as the SNX price keeps increasing, you make more, but rewards locked for a year. If you believe in balancer, go on to, I think it's predictions.exchange, find the highest APR pool with the assets you hold, going on that. And then I think just keep a lookout for any new projects which are have good reputations behind them and which you believe in, and have the assets you want, because that's where I think you'll find a lot of really cool alpha opportunities.
Yeah, I definitely agree with the synthetic zone. I'm farming the curve SUSD pool. I sort of didn't really, I don't know why I didn't buy. I mean, I knew about synthetics for a long time. I just didn't put my money where my mouth is. So kind of miss out on synthetics. But hey, I mean, if I'm farming them and getting SNX for free, that sort of covers back whatever opportunity cost. Because, and then as we know, like the longer I farm like these tokens, like I'm kind of forced to hold them, and then like over time it just increases in value as well. So yeah, that's sort of what I do as well. Do you use any websites in particular to search for new farms or APY? I mean, prediction exchanges .exchange is one of them that Kerman mentioned. Michael, maybe you have some?
Yeah, so I saw this up. Miles knows what's up. Yieldfarmingtools.com. Absolutely, that's a great one. Like it aggregates a lot of new farming opportunities, but just be very careful. It always ranks the highest yields first. So sometimes you'll see like 2,000%, but these are all pools with impermanent loss. So I guess I was talking about type 2 pools. This is type 2 pool. So you have to be very, very careful in that sense. I think obviously, I think in this video, I feel like I didn't cover the risks enough. I think Bobby was right in saying that there's a lot of risks here, and I kind of joked about it. I did lose a lot of money. There are situations where I think I did lose a lot of money on yams, but that was because I was stupid and I speculated on yams when I shouldn't have. And I also lost money on YFFI, and even in one point, YFII was going down, and it was just almost entering this kind of death spiral, I would call it. So there are a tremendous amount of risks associated, and I've seen people message me. They're like, what's happening? I put my house on it or something stupid like that. Remember, guys, we all do risk management very, very well. If you're in crypto for a long time and you're still around, passively, we're pretty good at managing risk, and we're playing with such small amounts of money. Whilst we're spending a lot of time on this, we're spending a lot of time on a very small amount of money. So this is actually really important, because a lot of people, they hear these numbers and be like, okay, I'm going to go all in. I put my house to it, whatever, stupid, like going to rack up credit card debt. Like that's nothing I do not do. I do not have a single bit of debt. I have a lot of assets that's not in crypto as well, because I actually want to have a long runway. I told people very publicly that I have an 8-year runway when I'm doing anything. So like, that's crazy, right? I can survive 8 years and I can just like peace out. Like if the bear market comes and it's 8 years, I'm fine. Even more right now. I think maybe like 20 years right now, I'm fine. But just be very careful. I think a lot of newbies, they come here and they just get burnt because they don't understand that passively, I think over these years, we're pretty okay at risk management. I think that's why we're still around. So just keep that in mind, guys. So Yield Farming Tools is a good place. Definitely following Daryl. I think like I joke about this, but I think Daryl really does know like when new projects are up. The other strategy I've heard people do is they follow QuantStamp. So like any of these smart auditing companies, because a lot of these new projects, they're getting audited first and then they launch, which means QuantStamp really has first dibs at what's good and what's new and stuff. So I think following QuantStamp employees are starting to become the newest thing to find the newest projects, or just Twitter and just shout and holler. Also, I'm going to do a shameless promotion for Boxmining. Follow this guy called Boxmining. I think he knows what he's talking about. No, just joking. We have a great channel on Telegram. We'll open that up soon to the public, but right now it's private, so I don't want to show it too much. But we share a lot of information there too, and I get a lot of info from the guys. So shout out to anyone in Boxmining Nation, Telegram. Shout out to y'all guys. You guys are great.
Yeah, definitely agree. Like follow Micah Boxmining on YouTube, and definitely follow Kerman on his YouTube and his newsletter as well. I kid you not, without Kerman's videos and writings in his newsletter, I wouldn't know much about DeFi. So I learned a lot. Of course, I learned a lot from Daryl, but like Kerman breaks it down very, very well in explaining all those concepts. So watch all the videos that Kerman has. Yeah.
Thank you. Appreciate that.
Any last words from you guys before we wrap things up?
I guess just talking about the whole thing about DeFi as well. So recently I spotted a trend where there's still, we're entering this supposed bull market. I'm actually really, really bullish on crypto and Bitcoin. Not everything's going to work though. That's the, if you learned anything from 2017, not everything's going to work. You're going to enter a phase where, the stupider, the better. Okay, so you're gonna have a lot of projects that are extremely stupid. They don't look like they should work, but they just keep going up in value for no particular reason. And I think a lot of people have this idea of price dictates everything, but price and value are very rarely correlated in a very bull market like this. So a lot of times, and I think there are a few friends that just bought absolute shit coins, like absolute shit coins, and they do like a 50x and whatnot, and they're off crazy and it's great. But there's a lot of inherent risk there, because when the market does cool down, you're going to be left with a bunch of zeros. So just be very, very careful about that, guys. This is quite an insane market. I don't want anyone getting hurt. I think there's a lot of opportunity here. I'm aggressively pursuing opportunities here. Absolutely. I have a lot of degenerate yield farming going on, but yet again, I manage my risks. It's all about risk management, guys. And I can't teach you that, not financial advice, but it's something that you guys have to learn by yourself. But there's a lot of volatility, and right now, almost anything works. It's like almost like pigs can fly, but pigs will crash down and they'll just become pork jerky. So just be careful.
Yeah, no, that's spot on. I think all of us enter into crypto and you get really excited, everything's going great until it's not, and then you kind of question your life. So make sure you don't question your life too much, and be a bit conservative rather than ultra aggressive.
Yeah, I completely agree. I mean, like this is crypto is super, super volatile. Like when it goes up insanely. You get a lot of money, but it also, what goes up must come down. You can't stay up and bubbly for the longest period of time. The bull market, we are entering a bull market season. Maybe it lasts for half a year, maybe 1 year, maybe slightly longer than that. But it wouldn't last forever. At some point, everything will come crashing down again, and then we enter another 3 to 4 years bear market. So Michael and I, we've both been in the industry long enough. Always be careful with the amount of money that you put into any of these risky endeavors. They can all go to zero. Do not put all your money in crypto. Get it out of crypto if you can. I mean, the reason we are degenerates like this is because we do proper risk planning, right? We know what we can afford to lose. These are money that if we lose it completely tomorrow, then like we are fine with it. But like if you're not, then you should really go for one of the safer opportunities out there in the space, and not go after chasing some of those like opportunities. So there are some safer ones that you can do and get better yields than what you can get in the banks. But yeah, always be very careful in the space. So yeah, I guess the best thing to do is to just really learn and read up, because the more you know, the better you understand the risk that you're taking. The worst is if you don't know what you're doing and you just like YOLO, just doing it blindly. That's like the worst that you can do.
Yeah. Last thing, I just want to show this. This is the newspaper in Hong Kong on Monday. So it was like front page Apple Daily. We have a giant Bitcoin logo on every single newspaper. It was pretty great. So I just want to say, Hong Kong guys, thank you. Then this was done by anonymous whales in Hong Kong. So they just like paid for this. Gigantic. Like Apple Daily is huge right now. You guys don't know how big Apple Daily is, but after all this political issues in Hong Kong, if you guys just search up of the history of what's happening here, Apple Daily is huge, and this was on the front page. So Bitcoin on the front page, and it just says like it tells the banks. I think this is a very big thing in Chinese. I guess you guys can't read that, but it says like it's basically telling the banks, today you're not ditching us, we're ditching you. I think that's such a powerful message, because right now in this time where politics is getting a little bit out of hand, it's getting a little bit depressing sometimes, and bank accounts are getting frozen all over the place, banks are going to ditch people in the future. So I think like this is a very powerful message for what we're doing like overall, and I think this is something that's super cool that it was all over Hong Kong. So I just wanted to give a shout out to the anonymous whales that made this happen, and that's cool.
Yeah, we've come to the end of the 5th CoinGecko meetup. It's been great fun having Kerman, Michael, and of course all of you here on the show. Like, thanks again, Kerman, Michael, for spending the time with us today.
No worries. Thanks a lot for having us. It was really great.
Thanks, Bobby. And by the way, use CoinGecko, guys. It's crazy.
I rate that as well.
All right. Okay. All right, guys, signing off right here. Take care, guys. Bye-bye.
Take care.